Good afternoon, everybody, and welcome to Preparing SORP for SORP 2026, an accounting update for Charities. My name's Mike Bath. I'm an audit partner and also a Charities and Academies partner at James Cooper Preston. And joining me this afternoon will be my colleague Bekki Foy, an audit director and also one of our specialist academy and charity advisors. We've got about an hour for the session this afternoon, covering quite a lot of ground, so we won't be able to get into any one topic in a great deal of detail. We should have some time for Q&A at the end, so if there are any questions as we're working through the material, please would everybody type them into the Q&A box, which you should be able to find at the bottom of your screen, and we'll pick those up in a wrap-up once all the technical elements have been completed. In terms of the things that we're going to cover this afternoon, firstly, a little bit on key dates, both as regards the SORP, but also some possible changes to audit thresholds, etc. We'll then deal with the concept of tiering as a new concept in terms of framing the Trustees report and the requirements for that. We'll then get into a couple of technical accounting areas, both of which are quite significant for many charities and which are quite new from where we've been before. I have a section on income recognition and specifically income recognition for exchange contracts. And then Bekki will be wrapping up with an overview on some of the changes for lease accounting that are coming in. So starting off with key dates, and we've got a mixture of SORP and audit threshold changes here. SORP 2026, as I'll insist on calling it, is applicable for accounting periods beginning on or after 1st of January 2026. So for most people in the room, the first year end affected will be 31 December 2026 or later. If anybody is planning on running a short period, perhaps 9 months to September from the 1st of January, please be wary because you will get caught by this. We probably have some new audit thresholds coming down the line for periods ending 30th of September 2026 onwards. The income threshold is scheduled to rise from £1 million to 1.5 million. The gross asset threshold will rise from 3.26 to 5 million. At the same time, the threshold for requiring independent examination will go up from £25,000 per annum up to £40,000, and the requirement for any independent examiner to hold an accounting qualification to certify those accounts, it will rise from income level 250,000 to 500,000. And non-company charities, so that's unincorporated associations, but also CIOs with income of up to 500k will be able to produce a receipts and payment statement. Essentially, cash accounting takes you completely out of scope of the SORP. That threshold would be effectively doubling from where we are at the moment. I say new audit thresholds probably only because DCMS, Department for Culture, Media and Sport, have consulted on this. They've put out a proposal, but to change the audit thresholds would require amendments to primary legislation. It will not have escaped anybody's notice that the government has quite a lot on its plate at the moment. So whether there will be time in the parliamentary calendar to pass revised or revisions to the Charities Act, probably before Parliament rises on the 16th of July, it might be touch and go. So watch this space, but it's quite possible that we won't actually get certainty on this until the very last minute. So moving on then to the concept of tiering. The SORP introduces the concept of tiering for the first time to create quite significant differential requirements within the Trustees report. Tier 1 is for those charities with income up to £500,000, that threshold again. Tier 2, income from £500,000 a year up to £15 million a year. And Tier 3, income 15 million and above. To put that into a national context, there's about 170,000 registered charities in England and Wales at the moment. Fewer than 1% of those have more than £15 million of income. It's actually a tiny number of charities. It's the Barnardos, the British Heart Foundations, the Cancer Research, the household names. But essentially, 99 point something percent of England and Welsh charities, and almost certainly everybody on this call today, will be in either Tier 1 or Tier 2. The reporting requirements are cumulative. So if you're in Tier 3, then you've got to comply with the requirements for Tiers 1 and 2 as well. Will Tier 1 stay at 500k? If people already remember the previous slide, we're going to a point where any charity that is not a limited company, up to 500k of income, doesn't even have to apply the SORP. It will be able to apply the receipts and payments point. At that point, maybe we have a tier with very, very few people in it. DCMS are aware of this, as are the SORP committee. They're having conversations. It may well be that by the end of the year, Tier 1 has actually moved so that we create a tier with a meaning number of respondents in it. In terms of the major changes to the trustees' reports, according to which tier you're in, just thought it would be worth putting everything on one slide, but we'll talk about almost all of these, or certainly almost all of the key changes in detail over the next few slides. So starting off with reserves, the headline here is that all charities are going to need to say a lot more about reserves than they already do. And essentially, the requirement that we have at the moment for larger charities under the new SORP, that will apply for every single charity. So we'll have the statement that we've had for a very long time. What is your reserves policy? What is your target amount of reserves and why? But under the new requirements, every single SORP reporting charity is also going to need to provide a reconciliation of reserves held. So if you talk about free reserves, how does that differ from total reserves? If you're talking about unrestricted only, make sure one is clear on how those are defined. If one has designated or committed funds, identify those, quantify them, and also put out into the public domain for the first time what is the likely timing of the expenditure against those funds. And finally, compare the reserves held from the policy, or with the policy. So if your policy says we're aiming for a free reserves target of £1 million and you've actually got 3 million, well, how have you accumulated that much money and not spent it? What are the plans to actually align the two figures? Some slightly enhanced requirements for volunteers. These are mostly qualitative, very few are quantitative. At the moment, we've got no requirement at all, really, for small charities to say anything about volunteers in their trustees' report. As a minimum under the new SORP, one will have to explain what kind of roles and activities volunteers are undertaking within the charity. Disclosure of hours, if you keep that data, is optional but not mandated. For Tier 2 charities, you've got that same requirement, plus also one should include more detailed disclosure. How many volunteers do you have? What kind of activities are they fulfilling within your organisation? Are they involved in frontline delivery? Are they involved in backroom roles? Are your only volunteers actually your trustees? All that kind of stuff, setting the context in which volunteers of all kinds operate within your charity. You may include hours or staff equivalents, again, if you keep that data, but there is not yet any requirements to do so. Impact reporting. This is probably the one that is going to cause the most thought for charities, because it's actually quite a long way from where we've been at the moment. At the moment, impact reporting is encouraged, but it's not mandatory. Actually, rather few charities do this. Lots of charities talk about inputs. They talk about, we spent this much money on project A, that much money on project B. Lots of people talk about activities. We did this, that, or the other. Impact reporting is slightly different. It's not about how much money one has spent or how many events one has put on or whatever. Fundamentally, it's about what difference have we made? How have we improved people's lives? How have we made the world a better place as a result of our charitable status? I'll talk a little bit more about this in the wrap up of the Trustees report session. Some charities will find their impact very easy to articulate because it's quite easy to see, and in some cases it's actually quantitatively measurable in the short term. Other charities, I think, will find this slightly harder, and I'll just touch on an example of that in a few slides' time. And finally, sustainability, only mandated for tier 3 charities and above, so that £15 million threshold, but this is an area of reporting that we actually see charities engaging with more and more, even those smaller charities who don't necessarily have to disclose this stuff, but lots of them like to. In many cases, it's because more and more institutional grant makers and institutional funders are asking for information like this. If you are going to report on sustainability, you need to start by providing a summary of how the charity is responding to and managing environmental, social, and governance matters, and how you weight the reporting across those 3 categories is entirely up to you. You may well provide KPIs, key performance indicators, if you're actually using those to assess progress against targets for climate and carbon-related risks. In terms of the S and the G in ESG, you might easily talk about things like cybersecurity, data security, not merely the charity's own data, but actually consider the personal data of your users and your beneficiaries. And many of the charities on the call today, your users will be some of the most vulnerable members of society. If their personal details are being leaked, that's probably quite bad news for them. It's probably also very bad news for the charity in terms of ongoing fundraising, reputational risk, etc. You'll almost certainly talk about diversity, inclusion, and do that across the board, whether it's your employees, your trustees, your service users. Been a lot of focus and a lot of reporting in the last few years on board level diversity. There's been slightly less focus actually on diversity amongst users and employees. And finally, perhaps talk about board recruitment and skills audit. How often does your trustee group look at itself and think, does the trustee group have the skills that we need to navigate the challenges that are on our table right now? What new skills, what new experience do we need to bring into our charity? How do we identify those skills, and how do we find the people who might be able to bring them to our table? And finally, on ESG, a reminder, those charities that qualify as large companies, so broadly income more than £36 million per year, gross assets more than 18, employees over 250, you will still be caught by the full SECR disclosures that I'm sure that you will all be familiar with, and I'm sure you've loved them for several years. So key actions now, just in terms of tiering. Firstly, be very clear as to what tier you're in. If your charity is close to a threshold in terms of your income level, or if your income level is highly variable, very much advise you to keep a close eye on the next tier up. Tier thresholds are 1 year only. There is no equivalent of the Companies Act 2-year rule. So it's quite possible and quite feasible that lots of charities will bounce up and down between 1 and 2 or 2 and 3 from 1 year to another. So essentially, a single unexpected item, maybe a donation, maybe an unexpected legacy a week before the year end, could actually completely change your reporting landscape if it takes you over a tier threshold. Where you've got new requirements, for example, ESG impact, be absolutely clear with the trustees and also the senior leadership team, the people on the ground. Be clear on what strategies, policies, and KPIs are in those areas, whether they're qualitative or quantitative. Do you actually have the systems in place to capture the data that will need to be reported at year end? Or are there changes that you need to make to your management information, your information capture systems between now and the year end? And I've said previously, impact reporting in particular may be very tricky for some charities. I've thought of one example there. For those charities who are perhaps delivering English or maths skills to adult learners, the impact on that person's life may only become apparent over many years after you've delivered the training, if that's enabled your user to get a better job, to enhance their life prospects. But those are things that may only manifest themselves over 3, 5, 10 years. So that will take some thinking about in terms of how do we measure the impact of things that may only manifest over very long periods. And that's it for trustees reporting. So now we're going to come on to some of the accounting requirements. I'll start with income recognition. Becky's going to deal with leases shortly. There's some quite significant changes to income revenue recognition, call it what you will. These are driven by broader requirements to UK GAAP coming out of FRS 102. So really, the SORP committee had no option but to adopt these because the FRS 102 said so. So they've taken the requirements over wholesale because they have no authority to change them. What they have done is provide a little bit of extra guidance as to how rules, which to be honest were written for profit entities, might actually be applied for the charitable and not-for-profit sector. The income module is now split very clearly into 2 parts: exchange transactions and non-exchange transactions. Non-exchange transactions, genuine gifts, donations, legacies. There are absolutely no changes to non-exchange transactions. So people who were hoping that the SORP committee might revise the very unpopular legacy recognition rules, I'm afraid you're out of luck for some years yet. For those charities that do have exchange transactions, and I'll come on to definitions in a moment, some of these will actually change quite significantly, and we'll look at a few examples over the forthcoming slides. There is a little bit of guidance in the SORP, particularly around things like grant income, which may be exchange or non-exchange, but a lot of this is judgmental. The SORP committee have deliberately not tried to be too prescriptive here because the sector is too broad and some of the issues are too granular to come up with relevant examples that cover all 170,000 English charities. So firstly, what is an exchange transaction? And I've copied that first paragraph there direct from the SORP. The key point in an exchange transaction is that the charity provides goods or services and it receives consideration that broadly reflects the value of those goods or services. Contrast that with a non-exchange transaction where the charity receives resources without being obliged, and that's a key word, to provide anything of equal value to the payer. A tricky area is likely to be grants. Grants can be either exchange or non-exchange. It will depend upon the precise wording, the requirements, the obligations. Where a charity receives grant income in exchange for transfer of goods or services, and there's a contract which is enforceable between the parties, that's an exchange transaction. Where the charity receives grant income and the grant maker does not receive broadly equal value in exchange, that is a non-exchange transaction. The difference will not always be clear without getting right down into the substance of the agreement. So as I've said, exchange transactions adopt the 5-step model. This is straight out of FRS 102. The headline here is that old recognition rules used to focus very much on the transfer of risks or risks and rewards to the payer. The new model revises that quite significantly and focuses on delivery of obligations to your customer. It introduces this 5-step matrix, 5-step menu. Firstly, identify the contract. Secondly, review the contract for the specific performance obligation or obligations. Determine the transaction price applicable to each element of the obligation and apply that throughout the contract, and recognize income as each individual performance obligation is met. Some income transactions will contain or may contain both an exchange and a non-exchange element. A membership fee is an easy example. An exchange element would be where there is a purchase of a right to services or benefits of some value. A non-exchange element would be more in the nature of you make a donation, but you're not getting anything of substance in return. Maybe you're getting a newsletter or something fairly trivial in value. And again, it comes down to the substance of the transaction. Exactly what are we obligated to provide? So we'll start off with a really easy example here of a membership fee. Let's assume that an annual membership fee includes access to a historic building and grounds for a period of 1 year. This is obviously an exchange transaction. The member is giving the charity some money. The charity has an or is providing a right to services, a right of access in this case, in return. Using the 5-step revenue model from a couple of slides ago, the charity would need to consider how any performance obligations are satisfied. So how might the member draw down the benefits from that membership? If you've got open benefit, perhaps you don't know how many times the member will visit or on which dates they will visit, unless perhaps there are any limits in the terms and conditions of the membership. In that case, the most appropriate method would simply be to recognise the income on a straight line basis, probably over 12 months, maybe over a shorter period if your building and grounds aren't open for the whole year. If they were only open for 9 months, you'd be spreading the membership over 9 months, not 12, because it's the 9 months where you have the obligation to deliver a service to that member. A slightly more complicated membership fee example, and it's the example of a county bird club or ornithological society. Annual membership of Hampshire Bird Club is £20, and in respect of that, members receive a quarterly email newsletter. It's a few paragraphs long, plus access to some small local events, members group meetings, etc. The members also receive once a year a copy of the annual county report, That's a substantial publication. It's 340 pages. It's full of glossy photographs. It's delivered free to members, but it is also widely sold to non-members at a retail price of £15 per copy. Under the 5-step revenue model, you've got 2 deliverables here. You've got an obligation to deliver a book with a market value of £15, which you do once a year. It's normally in November of every year. So under the revised SORP, the most appropriate treatment of that £20 membership fee is probably to split £5 evenly over the year and recognise £15 per member on delivery of that annual report. That's probably quite a long way from the accounting as it works at the moment. A second example, an organisation providing training and examinations. Slightly different methodology here. The total contract price is £8,000, and that is broken down and allocated to the individual performance obligations. The obligations under the contract are, firstly, to deliver training materials to the student at the outset of the 3-year course. Secondly, to deliver 3 modules over the course of the 3-year period, each of which is valued at £2,500. The course materials are recognised when they're delivered to the learner, whether that's physical documents or whether it's online. So they're recognised almost upon signing the contract. The revenue for individual modules at £2,500 each, that's recognised on an annual basis once that course or that tuition or that exam has been delivered to the learner. There's an example around non-refundable upfront fees, essentially a joining fee, as they're often called. So the idea here is the contractual arrangement includes a non-refundable or a joining fee at the start of the contract, and the charity carries out some administrative setup process, but no real goods or services transfer to the third party, the customer, at that point. And in this case, the revenue framework says that the upfront fee is simply an advance payment for future goods or services. Therefore, you recognise that revenue over the period when those services are provided, not in one lump sum when the fee is paid. And we'll go straight into an example on the next slide. So let's take the example of a membership fee for a golf club, where if one joins the club for the first time, as well as the annual membership fee, one will also get stung for a one-off joining fee. So we're looking at calendar years ending December 26 and 27. Joining fee is £3,000. Annual membership, which is on top of the joining fee, is at £7,500 for the year. Let's assume that our new member joins on the 1st of July 2026, so exactly halfway through the year. The contractual membership period is 12 months. There is no requirement to review at the end of that period. The joining fee in itself does not actually transfer a good or service to the customer. It's essentially an inflated fee for the services that are provided to that member over the first 12 months. Therefore, that joining fee, the £3,000, would be spread over the first 12 months of the membership. It would not be recognised in full at the point of joining. Sometimes we see revenue agreements which involve services being bundled and unbundled. They might be highly interdependent or interrelated, so essentially they're affected by other goods and services in the contract. And the promise of the contract can't necessarily be satisfied by transferring each of the goods or services independently. And we've got another example on the next slide. So an event sponsorship, that's those charities that actively fundraise from gala dinners and things like that. You may well have revenue agreements or sponsorship agreements like this. So a charity enters into a fixed fee contract with a sponsor, and in return, the charity creates and produces a promotional video for the sponsor covering the sponsor's activities. The sponsor also gets an invitation to the charity's events and other partner dinners. The sponsor gets to place their logo at those events and the dinners. The sponsor also probably gets the chance to maybe do a presentation, make some speeches, perhaps put up their film at those events. The events will not necessarily be specified in the contract and actually will likely vary from one year to another. And you've got two separate deliverables here. Firstly, there is the deliverable of the promotional video. Secondly, there's the access to the events and placing of one branding, etc. So in this case, the revenue treatment would be split the video out from the other services, allocate a sensible element of the total sponsorship price to the video, and actually recognise them as two separate things. You'd probably recognise the video income once that video has been created and delivered to your sponsor. The balance of the income, you'd probably recognise it over the course of the year or over the course of a determined number of events. So again, a little bit more complicated than probably where one is at the moment. So that's it, a brief run through of the revenue changes. The key things to be doing now. Firstly, look at all sources of your income and assess, probably in conjunction with your accountant, your independent, your examiner, or your auditor, whether income is exchange or non-exchange. Where you've got exchange income, apply the 5-step model. Start applying it now. This won't necessarily be quick or easy, where you've got things like bundled services, contingent consideration, delivery over long periods. Those are probably the areas where the standard will have the greatest impact, and in more cases than not, they're likely to delay revenue recognition rather than accelerate it compared to where you are at the moment. And start applying those changes to the recognition models in your current year management accounts. Don't leave this until after the year end. Firstly, because for a lot of charities, this is actually going to take a lot longer than anybody realizes. But also, going back to what we said at the start about tier requirements for the trustees report, about audit requirements, independent examination requirements, those are all predicated around income levels. So if you don't have a very tight view on what your income recognition looks like under the standard, then you potentially don't have a clear view as to what your trustees report requirements or even your audit or examination requirements are come year end. Preparation is key. That's all from me on income. I'm going to hand you over to Becky now, who will cover leases, and then we'll come back to Q&A at the end.
Thanks, Mike. So yeah, moving on to leases. So another significant change to the new charity SORP is this comprehensive overhaul of lease accounting. From the 1st of January 26, the entire charity sector will move from the traditional operating lease expense model to a far more transparent on the balance sheet approach. This shift is driven by the updates to FRS 102, which brings charity reporting close to the international standards, and a new demand for new processes, controls, and judgments from the finance team. These changes will only affect lessees, lessors will remain unchanged. The updated charity SORP applies to those accounting periods beginning on or 1st of January 2026. So, for example, a charity with a 31st of December year end will first report under these new rules for the year ended 31st December 26. Under the current source, most operating leases are simply expensed over a straight line basis. And permitted, with the exception of a few rules. These being short-term leases, so those leases with a term of 12 months or less, or where they are considered low-value assets. So a few examples of these would typically be your computers, tablet devices, and other small office furniture, but the SORP goes into a bit of detail of what's deemed low value or not. So in these instances, those assets still can be straight-lined. Under the new model, charities will now have to be required to recognise a right of use asset, a lease liability, and then subsequently the depreciation on the right of use asset and the interest on the lease liability. Both will be spoken about later on in some further detail. The capitalisation model applies to nearly all leases, making balance sheets a lot larger and fundamentally changing the expenditure presentation in financial statements. And also the traditional distinction between operating and finance leases is therefore really eliminated and replaced with the single accounting treatment. So really, in summary, for the changes to the leases, this could have quite a large impact on charities. Firstly, due to the increase in gross assets, which can affect the charity sizes, requiring possibly audits and independent examinations, whereas charities wouldn't have had to have that before. Or secondly, those with bank or operating covenants, these changes could result in a breach, thus worth discussing this with covenant holders earlier on and seeing what changes are upcoming with those set covenants. Next slide, please, Georgia. Thank you. So moving on slightly then. So once a charity has established that a lease agreement exists, along with a commencement date, a lease term, and that confirmation that they are exempt, the charity must proceed to measure the right of use asset and the lease liability. So calculating the right of use asset, this usually comes with the initial measurement of the lease liability, which we'll discuss slightly later. Any lease payments made at or before the commencement date, less any lease incentives received as well. Any initial direct costs by the leasee, for example, legal fees, and even commissions paid to leasing agents for successfully securing the leases. Also, the allowance for expected dilapidations or those similar costs of making good in order to return that asset back to the lessor at the end of the lease term. And then finally on that, the value of any social donations, which we'll look at with an example a bit later. Next slide, please. Thank you. So then moving on to lease liabilities and discount rates. The initial lease liability is not measured by the simple counting of the total amounts of money payable to the lessor by the charity, but also has to make an allowance for the time value of money. Measuring the lease liability involves calculating the present value of the lease payments due after the commencement date using this discount rate. But also when considering the future payments, there should also be regard to the existence of potential break clauses and the effect that these might have on identifying that non-cancelable period of the lease. So specifically looking at the discount rate then as well, the default is if the charity can readily determine the interest rate implicit in the lease, then that must be used. However, where this can't be readily determined, the charity can choose an incremental borrowing rate, which is defined quite nicely in the SORP. However, there will be instances where the charity is unable to readily determine both the interest rate implicit in the lease or the charity's incremental or obtainable borrowing rate. In these instances, the charity is required to use a rate of interest that it could otherwise be obtained on deposits held with financial institutions. This could be quite a suitable option for those charities that don't borrow money. And then with the subsequent measurement of that, the carrying amounts of the lease liabilities will be increased by the interest charge for the period, and then reduced by the lease payments made, and if appropriate, any adjustments to reflect things like lease modifications or changes in fixed lease payments. But then equally on the other side of that, the right of use asset will then be adjusted for by the accumulated depreciation, any impairment losses, and again, any remeasurements in those lease liabilities. So if we move on to the next slide, we will look at a couple of examples which will more likely be applicable to charities rather than the corporate companies. That's why we've raised these here. The first being social donation leases. So these are lease arrangements where payments are below market rate but higher than a nominal amount because the lessor has chosen to accept a lower rent in support of the charity. So these social donation leases have a non-exchange component, meaning the charity receives a benefit beyond what it pays for. When a charity has determined that they are party to one of these social donation leases, it must consider the nature of those income and resources and how it will determine to measure it. So this donation could be in a way of an asset or donated services or facilities to the charity. And then the value of the non-exchange component of that is added to the right of use asset and then depreciated accordingly. The measurement of the non-exchange component will take into account the lease payments that are actually made. And then when we're looking at an asset, fair value of an asset, or where we're looking at a service or facility, how much that would have actually cost. So looking at a practical example on the screen here, we've got a charity entering into a 3-year lease. Market rent is £72,000 per annum. The landlord has discounted it to £60,000 as part of their CSR responsibility, and then legal fees at £8,000. So when we're looking at the accounting treatment there, the right of use asset will be the full market rate, so it will be 3 times the 72,000 plus the 8,000 allowable to be added for those the direct costs added. And then the total lease obligation before discounting is the 180,000, which is the actual amount payable. However, previously noting when actually coming to do this, you will have to consider the discounting around that as well. So the balancing figure of the 36,000, as I already noted, is that corporate social responsibility discount, which will then be included as income, either recognised in full in 1 year or spread over the life of the lease, but that will just be dependent on the lease agreements given. So moving on to the next slide, we have one more specific example for leases, which will be quite common with some charities. This is in relation to a nominal or peppercorn arrangement. Typically, arrangements where charities pay nil or a nominal amount of consideration are known as these peppercorn leases. While these arrangements have a legal form of a lease, it is quite unlikely that it will meet the definition of a lease under FRS 102, as the payments are likely due to be either very small or nil. And then, any nominal payments that are actually made are treated as operating expense payments. And then in addition to this, the accounting of the nominal payments under such arrangements, the charity will need to consider the benefit that is being received and how it should be measured and accounted for. For example, if this arrangement is in place, it means that if an asset is available to a charity to use in its charitable activities, the charity will need to identify the fair value of the asset and account for it as a donated asset. And that treatment is in line with Module 6 in the SORP. And similarly, if they have received facilities or services, again, that they will have to recognise that as a donation again under Module 6 of the SORP. So again, looking at sorry, do you mind going back, Georgia? Looking at an example for this, Again, the Charities entered into a 3-year lease. The market rent for that, again, is the 72,000, and the landlord only expects £100 to be paid. So for the accounting treatment of this, the £100 is expensed through the SOFA as a cost, with the non-exchange component being the uplift to the market value would then be recognised as a donation. Perfect. So moving on now, please, Georgia. Thank you. So there are a huge variation to the leases, so many different considerations to be had of lease modifications, incentives, etc. So it would definitely be worth giving the SORP and FRS 102 a read in terms of the information it has for you. But the next steps for all charities to consider then need to start identifying all of your leases. Charities with a large number of leases, for example, shops, other land and buildings, car leases. This could be quite an extensive exercise, so it really needs to get the ball rolling now for the changes. Make sure all of the lease information is accessible and ready in one place. There are a lot of factors to consider when completing the calculations. So also referring to the SORP in conjunction with getting this lease information will be very beneficial to aid with the calculations. Also, although the SORP allows a single discount rate to be used across all identical assets, the charity still does need to apply the calculations to each of those individual leases. So that, again, can be quite a timely exercise. And again, like Mike said, adopt the changes in your management accounts as soon as possible. Don't leave that till after the year end. It puts you at risk for entering audit thresholds and kind of running out of time of finding auditors, etc. But also breaches in covenants, and you really need to start talking to those counterparties early and making any potential modifications to the covenants where needed, and also talk to your accountants and auditors for advice. That there is a lot of consideration here and advice to be given in this section. So that is kind of a very brief overview of some of, the major lease accounting changes, and I'll hand back over to Mike to conclude.
Okay, thank you very much, Becky. We've got about 12 minutes left of the available slot. So please do start with your Q&A in the box, should be at the bottom of your screen. We've got a couple of Q&A items in there already. It's the mark of a great client that they're always ready to kick the Q&A off with a really, really easy question. So Stuart from Merchant Navy Welfare Board asks, will the slides be made available after the webinar? Absolutely, they will. And in fact, Karen Perrier has just also asked the exact same question. So yes, we will share the slides with all registered attendees after the call. Question from Philip Everett. When SORP 2026 is first applied, do the figures for the comparative year have to be amended as if it had applied to them also? Really interesting question, because unusually the answer is not necessarily. Both the changes for both revenue recognition and accounting for leases do actually allow a reporting entity, in our case a charity, to make those adjustments at the start of the current period. So for a charity that reports to a 31 December 2026 year end, you can go back and do full retrospective restatement if you want to, but to be honest, that's probably going to be a bit of a headache, especially if you've got a lot of leases. Therefore, what the SORP allows you to do for both revenue and lease changes is to introduce a reconciliation between 31 December 2025 closing reserves under the old rules and 1st of January 2026 opening reserves under the new rules. So essentially treat it as a one-line adjustment at the start of the current period. Bearing in mind how painful lease accounting is going to be for some charities, I think that's a very sensible exemption, and I can't immediately think of a good reason why anybody would want to go for full retrospective restatement when you actually don't have to. I'll just wait a few more seconds to see if anything else pops up in the Q&A. I've got something else. Okay, another question from Karen. Where you receive a grant for core costs with activities about meeting strategic aims, would this be non-exchange income? I would need to read the exact detail of the grant in question, but I think it is almost certainly going to be non-exchange income, because there's nothing in the phrasing of the question that implies the charity is obliged to provide goods or services to the grant or of equal value to the grant given. So I think that's probably going to be non-exchange income. Okay, that looks like we're there on the Q&A because nothing more is coming in. Thank you very much from both Becky and I for listening to us this afternoon. We had quite a lot to get through, so we will share the slides after the event. Please do read them at your leisure, digest them, and come back to either of us or whoever is your normal JCK contact as you start to sort of process these. Think about what it means for your charity, what it means for your reporting environment. As always, we remain here to help. Thank you, everybody. Good afternoon.